So if you want to move a shipping container full of electronics across an African border today, the physical truck might take, what, maybe 3 days? But moving the actual money to pay for that container,
Oh, they could take 2 weeks. Easily.
right, 2 weeks. You have this physical world that is slowly optimizing, but it's being dragged down by a financial world that is, frankly, just stuck in the analog era.
It is a massive disconnect. I mean, for decades, we've measured a continent's economic progress by, the volume of concrete, poured new highways, power grids, that kind of heavy physical infrastructure.
But the reality on the ground has shifted entirely.
Welcome to the deep dive. We are so thrilled you're joining us today because we have this incredibly complex, almost invisible puzzle to solve.
And it's moving fast.
It really is.
Yeah.
Our mission right now is to extract the aha moments from the rapid, under-the-radar modernization of digital finance and infrastructure in Africa. So we are going to map out how physical ports are building digital twins, how cross-border blockchain payments are quietly solving massive liquidity crises, and the regulatory side too.
Exactly. How an unprecedented level of regulatory teamwork is allowing fintech to scale across the continent without all that old friction. Okay, let's unpack this, because the speed at which this is happening completely defies the traditional development playbook.
Yeah, the overarching thesis you really need to keep in mind today is this. This isn't simply a story of Africa passively adopting legacy technology from the West. I think that is a fundamental misconception a lot of people have.
So what are they actually doing?
We are watching Africa actively build the future architecture of professional connection and financial integration. They are constructing this frictionless, highly interoperable framework that, honestly, the rest of the developed world might very well be forced to copy soon.
Wow. Okay, but before we get into the really complex, invisible blockchain networks moving capital across borders, we kind of have to look at the foundational plumbing.
Yeah, the stuff on the ground. Right, the physical reality of doing business. So if we look at the strategic agreement between Orange Business Senegal and Sonapad, their mandate is to completely digitize and modernize the Port of Dakar.
Which is a massive undertaking.
Huge. But what does that actually mean mechanically? I mean, a port is just ships and cranes, right?
Well, the ships and the cranes are actually the easy part. The real bottleneck of a physical port is the paperwork.
Oh, of course.
Historically, when a cargo ship arrives in Dakar, you are dealing with physical manifests, manual customs clearances, multiple layers of local authorities requiring literal physical ink stamps.
And ledger reconciliations, I imagine.
Exactly. If a container sits on a dock for 2 weeks waiting for someone to sign a piece of paper, you incur massive demurrage charges. So what Orange Business Senegal and Sonapad are doing is building a unified digital ecosystem.
So replacing the clipboards?
Completely. They are replacing manual clipboard ledgers with interconnected API systems. So now customs, the logistics companies, and the port authorities, they all share data in real time. Okay, so they are upgrading the physical hardware of trade, basically making sure the actual shipping containers can move at the speed of data.
Precisely. You eliminate that analog friction right at the point of entry.
But the container leaving the port is only half the equation, right? Because the local businesses receiving those goods need a way to actually process the commerce. And I think that brings us to Numba.
Ah, yeah. Nomba is a perfect example here.
The evolution of this platform is just staggering to me. They started out simply as a chatbot named Kuti, which it just helped people make basic transfers.
Just a simple messaging interface.
Right. But today, Nomba has evolved into this massive fintech platform providing holistic payment and financial management tools for hundreds of thousands of African businesses.
The trajectory from Kuti to Nomba, it perfectly illustrates the maturity of the market. A conversational interface was a great onboarding tool back in the day.
It gets people in the door.
Exactly. But a growing business needs a lot more. They need to manage inventory, they have to handle payroll, process omnichannel payments, and, critically, access credit.
So if the Port of Dakar digitization is the hardware upgrade of trade, I'd say Numba represents the software upgrade.
I like that analogy.
Right. It's giving these local, everyday businesses a supercharged digital nervous system to actually manage the money flowing from that trade. And suddenly, a local merchant has a verifiable digital history of their cash flow.
Which fundamentally changes their ability to get a bank loan.
Exactly.
And what's really fascinating here is how those two infrastructural pillars rely on each other. I mean, you can deploy the most sophisticated digital payment suite in the world to a merchant in Senegal.
But if their goods are stuck?
Right. If their inventory is trapped for 3 weeks at an analog port waiting for a physical stamp, their business still stagnates. By digitizing a major fiscal hub like the Port of Dakar, alongside scaling local digital payment platforms like Nomba, you're creating this frictionless domestic loop.
So trade and capital finally begin to move at the speed of the internet.
Exactly.
There's always a but. That domestic loop is where the frictionless experience abruptly ends, right? Because local digital payments are lightning fast. But what happens the second that newly digitized merchant in Dakar needs to buy supplies from, say, a vendor in Nairobi?
Oh, they hit a wall. A massive, expensive, invisible wall of legacy correspondent banking.
Right, because an African bank in one country often doesn't have any direct relationship with a bank in another African country.
Exactly. It's so inefficient. To move money from Senegal to Kenya, the funds often have to be routed out of the continent entirely.
Wait, really? Out of the continent?
Yeah. The Senegalese franc gets converted to US dollars or euros, then it's routed through a clearing bank in New York or London, then it gets converted again into Kenyan shillings, and finally deposited.
That sounds incredibly slow.
It is. Every single hop takes time, and every single bank takes a fee. So you lose all the speed of that digital upgrade the moment the transaction goes international.
Which naturally forces the ecosystem to find a bypass. And I think that brings us to the blockchain bridge. If we examine the intelligence we gathered, traditional financial institutions are actively leaning into Web3 to solve this exact bottleneck.
They don't really have a choice if they want to stay competitive.
Right, like Nedbank, for instance. They have officially partnered with Crypto.com to enable much faster cross-border payments. And the key here is they aren't using traditional banking rails.
No, they are using blockchain technology and USD Coin, commonly known as USDC.
And this is scaling rapidly, too. Ripple is currently expanding its global payments network across more than 60 markets.
Which fundamentally strengthens the role of XRP, their native token in, facilitating these scalable international payments.
Yeah.
We are seeing a complete infrastructural pivot right now.
We really are. And the voices on the ground are confirming this isn't just some abstract theory. Look at the insights coming from the Kenyan frontier in our sources.
Edwin Dande's comment stood out to me there.
Yes. Edwin Dande makes this crucial point, deliberately separating general crypto from the specific utility of stablecoins. And then Robert Kirby states very clearly that Africa isn't just exploring crypto, the continent is actively living it.
Which is such a vital framing for you to understand as you're listening to this. This is not a pilot program. It is daily operational reality. And frankly, it perfectly mirrors the highest levels of global financial evolution.
Like what's happening on Wall Street.
Exactly. Just look at the recent developments with NASDAQ exploring tokenized collateral.
Okay, let's pause on that for a second because tokenized collateral sounds like really dense financial jargon. What is actually happening there in plain English?
Fair enough. Tokenized collateral is essentially taking a real-world asset like a treasury bond or maybe a piece of commercial real estate and creating a digital twin of it on a blockchain, a token.
Okay, so a digital representation of a real asset.
Right. So instead of taking days to physically transfer the legal rights of that asset to back a loan, you transfer the token instantly via a smart contract. The point I'm making is, by leveraging stablecoins and tokens for instant settlement, Africa's tapping into the exact same high-level tokenization mechanics that are currently reshaping NASDAQ and Wall Street.
Wait, I have to jump in and push back here a little bit. We know stablecoins like USDC are meant to solve the volatility issue of crypto, but liquidity across fragmented African currency corridors is notoriously thin.
It can be, yeah.
Right. So if our merchant in Dakar is trying to pay that supplier in Nairobi, how are USDC and XRP actually bridging illiquid local fiat currencies without incurring massive slippage, where the price changes dynamically during the trade on both ends?
That is the exact right question to ask, and it gets right to the heart of how this technology actually functions mechanically. We really have to separate the concept of crypto as an investment from crypto as infrastructure.
Right, like Edwin Dande pointed out. The utility of a stablecoin is entirely different from buying a speculative token hoping it goes to the moon.
Because USDC is pegged one-to-one with the US dollar. It's stable by design.
Right. But to your point about liquidity, how does it mechanically bypass the clearing banks in New York?
Instead of routing fiat currency through New York, these platforms use what is known as on-demand liquidity.
Okay, how does that work?
So when the Dakar merchant hits send, their local currency is instantly converted into a highly liquid digital asset like USDC or XRP via a local exchange.
Got it.
Then that digital asset is fired across the blockchain in about 3 seconds to an exchange in Kenya where it is instantly swapped into Kenyan shillings and deposited.
Oh, wow. So the blockchain essentially acts as a universal translator for money.
Exactly. The digital token acts as a bridge currency. Because you are accessing decentralized liquidity pools in real time, you don't need a centralized correspondent bank to hold millions of dollars in idle accounts just to facilitate the trade.
The value just moves from wallet to wallet globally.
Settling in seconds for fractions of a cent.
That is wild, and obviously that drastically lowers the cost of doing business, and here's the other side of the coin. It also introduces a terrifying vulnerability for a government.
The compliance side.
Yeah. If billions of dollars are suddenly flying across borders on decentralized networks, bypassing traditional banking checkpoints entirely, how do you stop money laundering? How do you prevent terrorist financing?
Well, you need regulation. But applying legacy banking regulation to a decentralized network is like trying to fix a smartphone with a hammer. It just doesn't work. You need incredibly smart, bespoke regulation.
Which naturally drives us to our next major piece of the puzzle, the regulatory shield. Specifically, how Rwanda is constructing its Web3 ecosystem.
They are really leading the charge here.
They are. Rwanda's cabinet recently approved a draft law to regulate virtual assets. But the most revealing detail of this legislation, and this is key, is that it specifically excludes traditional fiat currencies.
And that exclusion is a deeply calculated structural choice.
There is immense pressure to get this right. If we look at the analysis from advocate Kato Patrick Iradukunda regarding the rise of virtual assets in Rwanda, he points directly to these legal challenges.
Yeah, he laid it out very clearly.
He highlights the existence of scams, the widening legal gaps, and the absolute necessity of protecting investors by building a strong, specialized crypto legal framework.
Because when technology outpaces legal definitions, bad actors exploit the gray areas. I mean, if a smart contract gets hacked, but the government has no legal definition for what a virtual asset even is, the authorities have absolutely no jurisdiction to prosecute.
Here's where it gets really interesting, though.
Yeah.
How does a country like Rwanda write rules that are strict enough to stop scammers and protect investors, but flexible enough not to scare away the next massive fintech startup?
It's a tightrope walk.
Because if they get too heavy-handed, the innovation just moves to a friendlier jurisdiction.
Yeah, exactly. And the secret is entirely in how they isolate the technology within the law. By deliberately excluding traditional fiat currencies from this draft law, Rwanda is creating a legally ring-fenced regulatory sandbox.
But why does excluding traditional currency achieve that? What's the mechanism?
Because traditional banking laws require things like physical branch security, massive fractional reserve capital requirements, and manual reporting structures that simply do not map onto a decentralized fintech company.
Right, a Web3 startup doesn't have a physical vault.
Exactly. If you force a Web3 startup to comply with the exact same laws as a 100-year-old commercial bank, you suffocate the technology before it even launches.
That makes total sense.
So by separating the rules, the Rwandan cabinet can mandate strict anti-money laundering checks and require on-chain analytics to track wallets, which protects the user without forcing the startup to pretend it's a traditional bank.
So they acknowledge the architecture is fundamentally different, and they tailor the compliance to fit the actual technology.
Yes. And that tailor-made approach sends a massive signal to global capital. It tells developers and investors, hey, we understand the mechanics of what you are building, and we have constructed a legally clear, safe environment for you to deploy it.
That level of clarity is a massive competitive advantage. But, and there is always a geographic but when we talk about localized progress, getting the regulation perfect in one country, like Rwanda, is phenomenal. But Africa is a continent of 54 distinct nations.
Then regulatory fragmentation is the ultimate enemy of scale.
Right.
If a fintech company builds a brilliant cross-border payment app in Rwanda, but they have to hire new lawyers, undergo redundant audits, and fulfill entirely new capital requirements just to launch in neighboring Uganda or Kenya, well, the friction returns.
The digital borders become just as impassable as the physical ones.
Exactly.
Which brings us to perhaps the most impactful breakthrough in today's deep dive. Breaking down those digital borders with licensed passporting. The central banks of the region are actually teaming up.
This is huge.
We have a Memorandum of Understanding, an MU, signed between the National Bank of Rwanda and the Central Bank of Kenya. This introduces a licensed passporting framework specifically for payment service providers, or PSPs.
This is a structural masterstroke for the region's digital economy, truly.
Let's look at how this works mechanically based on the agreement. It basically allows licensed payment firms to operate across both markets without starting from scratch. It drastically reduces duplicative regulatory processes.
But they aren't just letting companies run wild, obviously.
No, no. The agreement mandates strong, shared supervisory cooperation between the two national regulators.
Right. And just think about the massive reduction in overhead for these startups. Instead of paying a Big Four accounting firm twice and hiring two separate compliance teams to satisfy two different central banks, the regulators are agreeing to mutually recognize the rigorous checks that have already been done.
And this MOU isn't happening in isolation. It's part of a much larger web. It directly supports the East African Community, or EAC, Cross-Border Payment System Master Plan.
Which is incredibly ambitious.
It is. The entire goal of that master plan is to build a deeply integrated, efficient regional payments ecosystem. Plus, Rwanda has a track record here. They previously established a similar license passporting agreement with Ghana.
Bridging the massive markets of East Africa and West Africa.
So what does this all mean for the end user? Is this essentially creating a financial Schengen zone for Africa?
Oh, I like that.
Just like how you can drive across Europe without stopping at a border checkpoint, this allows digital money and fintech services to cross national lines without regulatory checkpoints. Like, if an app gets a passport in Kigali, it can immediately start onboarding customers in Nairobi.
The Schengen zone analogy is perfectly accurate, and if we connect this to the bigger picture, you can see how this completely rewires the economics of starting a tech company in Africa.
How so?
Well, you're taking previously siloed, fragmented nations with their own limited market sizes, and you are stitching them together through regulatory interoperability.
Oh, so it changes the total addressable market overnight?
Exactly. You aren't pitching venture capitalists on an app built just for 13 million people in Rwanda. You're pitching an app that has immediate passported access to 54 million people in Kenya and potentially tens of millions more in Ghana.
That is a completely different investment thesis.
It guarantees that a good idea can achieve continent-wide scale rapidly. Central banks are actively sharing data, cooperating on oversight, and agreeing that if a company's architecture is secure enough for one nation, it is secure enough for the other. It's just an incredible display of institutional agility.
We have connected a lot of seemingly disparate dots today, but the final picture is undeniable. Let's do a quick recap for you, the listener, so you can really see the full magnitude of this shift.
Good idea.
We started on the ground, looking at how the literal hardware of trade is being digitized at the Port of Dakar through Orange Business Senegal and Sonapad, and we paired that with the software upgrade of local merchants through Nomba's evolving platform.
But because local speed is basically useless without cross-border fluidity, we examined the blockchain bridge. We broke down how partnerships like Nedbank and Crypto.com, along with Ripple's XRP network, are utilizing stablecoins like USDC.
Right, to bypass legacy correspondent banks entirely.
Exactly, providing instant liquidity across borders.
And to prevent that high-speed network from turning into the Wild West, we looked at how Rwanda is pioneering smart regulation. By explicitly excluding traditional fiat from their virtual asset laws, they created a bespoke environment that neutralizes scams without suffocating the underlying Web3 technology.
Which naturally culminated in the licensed passporting frameworks. Those agreements between Rwanda, Kenya, and Ghana that effectively erased digital borders, allowing this newly regulated blockchain-powered financial system to scale across a unified market.
So why does this deep dive matter to you? Because you are watching the blueprint for the next century of global finance being written, tested, and deployed in real time. This is not just a regional narrative.
Not at all.
It is a masterclass in how agility and regulatory cooperation can help entire economies leapfrog legacy systems. They aren't trying to patch the holes in the old banking system. They are building a brand new, frictionless operating system right over top of it. Keep your eyes on this invisible infrastructure because it is moving faster than anything we've seen before. Thanks so much for joining us on this deep dive.
And, as you think about this new architecture, it raises a profound, almost uncomfortable question about the future of global power.
Oh.
Yeah. If an entire continent eventually shares a frictionless, decentralized digital currency layer moving value instantly through smart contracts and stablecoins, completely bypassing localized central bank clearing, what happens to national sovereignty?
That's a huge question.
If a nation can no longer control its money supply through traditional interest rate levers because the commerce is running on a borderless tokenized network, how long before the very concept of a national economy becomes obsolete?